Well, this webinar today is made possible through the Forestry and Natural Resources webinars. This is partnership with Bob Barton, Bill Hubbard, and myself, Eric Taylor. Today's webinar again will be on timber tax. If you would, take your polling questions there and respond to the location in which you are participating in this webinar from: Pacific, Mountain, Central, Eastern, or other. Please use the polling tab, polling button, which is just below your name. So both are participating from Central location and Eastern location today. All right. Well, that's a quick run through, and in the interest of time, I think we'll get started with today's webinar, and I'll ask Dr. Linda Wayne to give just a brief introduction of herself before she gives the information. So Linda, take it away.
Good morning. I hope everyone can hear me. And I am Linda Wong. Thank you. I am a National Timber Tax Specialist with U.S. Forest Service. Thank you so much, Eric Taylor from AgriLife, the extension arm of the Texas A&M University, and Dr. Bob Barton from North Carolina State Extension, and also Bill Hubbard, the head for the Southern Regional Forestry Extension. They have spent a lot of time to put together the webinar today. I really appreciate their partnership. Thank you. Well, this year is for federal income tax is 100 years old. The system is 100 years old. 100 years ago, 16th Amendment to the Constitution was ratified, granting Congress the power to collect income taxes on your income. And so over the years, the tax law certainly get complicated year by year. So today we will go over how to report a specific section of the tax code, timber transactions. We'll also go over the new tax provisions enacted from the fiscal cliff package. Of course, today the discussion are educational. They're not legal or accounting advice. So one of the first things when we talk about the timber taxation is, how is my woodland property classified for tax purpose? This is very, very important because it has important implications for how to report your income and how you take the deductions. Now, if you own your woodland property for personal purpose, for example, you do hunting, fishing, and use the property for family retreat, then you may hold your property as a personal property. Now, one of the kind of drawback of holding your land as a personal property is that the deductions are limited. And if you have a loss from personal property, that means you have expense exceeding your income, then normally that loss is not deductible for personal property, except when they are casualty loss, which are also subject to more severe restrictions. Now, if you hold your timber for income producing purpose from timber production, that'll put you in this investment or business category. Now, the distinction between investment and business, there are no clear set rules that says your property is investment, my property is business property. There are some guidelines the Internal Revenue Service set, and we will go over that guideline. But in general, if your activity is not as regular, active in your timber business as a business, doesn't rise to the level of business property, then you may be in just the investment property level. And as I said, both investment and business category, you do have more tax advantage situation. So what qualifies as a business? The first set of guidelines from the Internal Revenue Service is to look at your profit motive. Does the activity make profit? Now, they have a presumption rule here. The Internal Revenue Service presume an activity is for profit if it makes a profit during at least 3 of the last 5 years. And this rule is used for all types of business. Now, for timber, this rule is really not very applicable because we may not have income every year, not every 5 years maybe. So now, the good news is that this profit definition also includes expectation that assets appreciate in value. Now just remember, this definition certainly is more appropriate for timber transaction, and that means that your timberland appreciates the timber grow in quantity and also quality, shifting product from pulpwood to saw timber. The asset does appreciate in value, and that does meet the profit requirement. There are a couple of other factors that they use to determine whether an activity is business or not. For example, does the time and effort put into the activity indicate intention to make a profit? If you if you put a lot of effort into it, that would be a good indication. Does the taxpayer depend on income from the activity? Again, this one I would think many people is able to depend income from timber because we don't have regular income. But just to know that if our return is challenged, these are the rules that the tax person is using trying to build your case. Does the taxpayer or his advisors have the knowledge to carry on the activity as a business? Okay, and then the last two factors, does the activity make a profit in some years? Did you have a timber sale in the past? That's a good indication of whether you are holding your property for income producing. Has the taxpayer made a profit in similar activities in the past? So the main reason when we say whether your property is a personal or an investment or business is whether you can deduct the expenses. The rules are different. Now, if your timber growing activity, if your woodland is considered a business, then here's a rule to deduct those expenses incurred for managing your land. All the ordinary and necessary business expenses are deducted in full on Schedule C, and this is only possible for what's called maturely participating in your business, those mature participants. And to determine whether you are a material participant or not, those depend on the hours that you participate in timber business. They have about 6 or 7 tests that you can use. One of the main one is if you participate in the business for more than 500 hours, then you are assumed to be a material participant. Now, the reason that we discuss whether you materially participate in a business or not is because there's a rule called passive business rule. Now, if you don't materially participate in your woodland business, your activity may be passive. And if that's the case, loss from the passive activity, now the loss means your expense exceed your income, that loss cannot offset income from non-passive activity. What is your non-passive activity income? For example, your retirement income, your salary, W-2 paycheck. If you're a contractor, your contract income or your self-employment income, these are all non-passive income, and the loss from passive activity cannot offset all these income. Now, you can carry forward the loss from the passive business activity until later years when you have a passive income from that activity. There is another restriction for business, is that if you don't meet the profit objective, the profit that we're talking about, including the expectation that the asset appreciates in value, that's a good defense for the timber property owners, then your property may be a hobby. Your activity may be considered a hobby. Now, so if you have report your expense on Schedule C and take the deductions, and if the return is challenging saying that's not a business, it's a hobby, then the losses that are deductible for a business are disallowed for a hobby. So what's the best way to document your income producing purpose for timber owners? One of the best ways is to include income production and cash projections in your forest management plan or your stewardship management plan. That's a very good place to put those languages in there to indicate your purpose of holding timberland. So here is the major difference between the investment property and the business property in deducting expenses for investment property, is that yes, those expenses are deductible, but you deduct them on Schedule A, itemized deduction. And on that deduction, it is subject to 2% of your adjusted gross income, which means your deduction is reduced by 2% of your adjusted gross income. It can reduce it to even to be 0. Now, if in any year that your adjusted gross income is too high, and instead of deducting them on Schedule A, you may elect to keep them in the cost of your timber, and that means that you don't deduct them and you wait until you have timber sale or you have a casualty loss. You can deduct, recover those costs then. So I wanted to show you an example of the 2% rule here. Let's say your adjusted gross income was $40,000. The adjusted gross income is the last number on the first page at the bottom of your first page of 1040. So it's the income that's adjusted by some adjustments, for example, your moving expense, some self-employment tax deduction, half of that, and some kind of adjustment, but before you take your personal exemption or your standard or itemized deduction. So this one is not your bottom line taxable income yet. It's your adjusted gross income. $40,000. Your Woodland expense was $1,000. Now, can you deduct that $1,000? Yes, you can deduct that $1,000, but when you put that $1,000 on the Schedule A and go through the calculation, only $200 is able to be deducted. So 2% times your AGI, in this case, it's $40,000, and that's $800, and so that gives you $200 deduction. Now, if your AGI is $50,000, then your deduction here would be 0. So just remember that this is one of the distinctions between investment property and the business property. So business property, you could deduct the expense in full, but you also have restrictions of passive and hobby loss rules there. So let's do a quiz. This is a true or false. Is Form T, forestry activity, a tax form? And you can choose a check by typing 1, or is this true or false? And you can give me your response. I saw several responses already. The reason I'm asking this is that for some, what I find over the years, there are always people who haven't heard of this form. And thank you for all of those you who have responded. This Form T is actually a tax form. It's called Forestry Activity Schedule. It's designed by the Internal Revenue Service, and it's used for reporting timber transactions. So we will go over who are required to file this form and what's the composition of the form. The form has 5 parts. The first part is called acquisition. This means when you acquire your property, whether you inherited it, you bought it, then that part, it's quite simple to fill out, and just your name and the location of the place and the acreage. Now, timber depletion, Dr. John Green, which is second speaker today, will go over that in detail, and you will be able to know how to calculate that. That's part 2, and then profit or loss from land and timber sale. So if you have a timber sale, we'll go over whether you are required to file, but it's always good to use this Form T for record-keeping purpose. It's good to keep record using this form. Reforestation, stand activity. Stand activity meaning you have a thinning operation, you did fertilization, all kinds of things, fire control expenses you can put in there. Ownership is if you decide to sell your land and change the ownership of the land, then this is the part to fill out. It's a very easy part. Who are required to file Form T? The instruction to Form T says, file this form only if you claim a deduction, a depletion deduction, whether you are an investor or you are owning a timber business. Again, we'll go over depletion later. And if you sold your standing timber and if you sold your cut timber, which means you didn't sell the timber on the stump, you didn't sell your standing timber. Instead, you have someone cut for you or you cut yourself and sold this cut timber, and you are a business participant, not an investor here, then that transaction is the second category called Section 631A. In that case, you are required to file Form T. But Dr. Green will go over Section 631A in his part of the talk. Then in a third situation, when you make an outright sale, and if you are a business category, you are required to file Form T, and that's called a Section 631A, which we're going to go over later too. And so in this 3 cases, the taxpayer are required to file. However, if you are infrequent timber sale taxpayer, infrequent sale meaning 1 or 2 sales for every 3 or 4 years, and so for many small woodland owners, you're probably a infrequent timber sale that the instruction says you're not required to file, but it's prudent to file, especially if you're in a business category where you can deduct your expenses. You do want to get yourself familiar with Form T. Here's another quiz here. What form is for reporting woodland business expenses? Do you report it on A, Schedule A, or C, Schedule C? I guess I should put a B here, but you can type in your expense on A would mean, check would mean Schedule A, and then C would be A cross. So to read this question is the business, this word here. Now the business is meaning on Schedule C, not on Schedule A. Schedule A is for people who own their woodland property as investment property. So the correct answer is C. Thank you. Timber basis So when do we need to be concerned about timber basis? Just about any time if you own timberland, but particularly in two situations, they affect your deduction. That means that when you have acquisition, when you have sale, that may involve basis. There's another situation if you want to take the casualty loss, that also an opportunity to recover your timber basis. Now, the reason, like I said, basis reduce your sale proceeds and thus save you tax. So what is basis? Well, it depends on how we acquired the property. If you purchase the property, now your basis is the purchase price plus other acquisition cost allocated between land and timber. We're only talking about the basis for the timber part. If you still own your land, you do not recover until you sell it. You can, if you sell timber, you only recover the basis for the timber. The other acquisition cost, meaning if you hire a forester to help you with the transaction, his fee is part of the acquisition cost, so don't forget that part. If you hire an attorney to look over the contract, and that's also your acquisition cost. So that's a good thing to increase your basis. If you inherited the property, then the basis is reset. It's not the basis when mom and pop, when they bought it or they inherited, which could be very low. If you inherited it, then the basis for you is the fair market value of the timber on the date of the decedent's death. So that requires you to hire a real estate appraiser or a consulting forester who are knowledgeable about timber appraisal, give you a fair market value of timber on the date of death, and that you put in your record. So when you sell timber, it's going to save you taxes, especially if you qualify for capital gain, save your capital gain tax. If you get the timber while mom and dad are still alive, and they gave the property to you, they made a gift for gifted property. Now, that's a little bit disadvantage, is that the basis in your hand generally is the cost in the donor's hand. Unless the fair market value of the property has decreased, then you may take that as the basis. So the tax law here is if the timber is gifted to you, then the basis normally carries from the donor to you. And that may not be a good thing when you sell timber, because that you may incur some capital gain taxes. So these, whether you're going to inherit the property or give the property, you wanted to see if the basis is high or low, and that affect later when you sell the timber. So here's an example of timber basis. Well, you can see actually it's broken down by the pine saw timber, the hardwood pulpwood, by different product, because they are priced and valued differently. This is the example of, like, for saw timber, $9,000 and $300,000 per 1,000 board feet, and this landowner have 30,000 board feet. Here's another quiz. If your woodland is an investment property, the expenses are deductible, but are subject to 2% of your adjusted gross income floor. Is this true or false? Thank you. Okay, the majority of you choose it's correct. This is correct. This is the key word, the investment property. The expenses are deductible, but if you report it on Schedule A, they are subject to 2% of your adjusted gross income. Thank you. Cost share payment. are some of the payments that the landowner received from forestry or natural resource conservation agency to cost share their practice in their land, reforestation, thinning operations, and people are asking whether the payment that they receive is that income to them or not when they file their tax return. Now, in general, cost share payment must be included in your income unless it qualifies for income exclusion under this tax code section 126. That's the general rule. And so fortunately, section 126 has a very favorable tax treatment for forest owners, is that a lot of payment does qualify for exclusion. However, the excludable cost share payment must be from the approved program, and it must be used for capital projects such as reforestation. Now, if you use to thin your forest or other type of deductible expense, fire control, southern pine beetle control, that if you didn't do a capital project, then you must include that in your income. This capital project requirement is directly from the tax code. If you have a timber loss from forest fire or from the hurricane or the other kind of storm damage, how do you report that? Now, those forest fire and the hurricane damage and those other weather damage, if they're sudden, unexpected, and usual, they are called casualty for tax purpose. Now, a casualty loss is deductible. However, the amount of deduction is the smaller of the fair market value loss of the timber or the timber spaces. Now you can see the timber space. So it's not just how much that the loss you suffered that's deductible on the tax return. It is also subject to the spaces here. It's the smaller amount of the loss and the basis. And there is an important note here is that the timber basis and the fair market value loss, how do you value that? The valuation for the property unit is for the entire timber account. This just means that if you have one tract, only a third of them was damaged, you can use the entire basis for the entire tract, the timber basis and fair market for the entire tract to claim the loss here. And so that's actually good for you because your basis is higher for the entire tract. If you keep track of all your tax transactions for the entire timber property. If you have two separate tracts, but you keep them together for tax purpose, you can use that as one timber account. You can use the basis for the two tract, even though you know there are two tracts, but for tax purpose, you do treat them as one timber. That's okay. So here's another quiz here. I see some questions. I will answer those questions, and after I talk, and then Dr. John Green start his part. Is cost share payment income? A, yes, you must always include it in your income. B, no, it's not taxable. C, yes, but certain qualified cost share may be excluded from your income. You can choose A or B or C.
Hold on one second there, everybody. Let me switch that. I can't seem to switch it when people are already answering. Isn't that weird?
Sure.
Hold on. Oh well. It's not allowing me to do it.
Yeah. Okay.
There we go.
Okay. So I guess, yeah. Okay. People are saying most people got it right. Yes. Yes. It can be excludable, but only certain qualified ones may be excluded, meeting those two requirements from the approved program and for capital project. Approved program, CRP, the wildlife, the WEEP program, the several other forest health management program, that's the Southern Pine Beetle, that cost share program, but only if you use the capital project. Otherwise, you have to include that in your taxable income, even though you already spent it. Okay. Now we understand that Form 1099-S is required for almost all timber transactions, whether you sell it lump sum or you sell it outright, or pay as cut sale. A Form 1099-S is required. As far as who must issue this form, this is what the instruction says on this form. The person, including attorney or title company, responsible for closing the transaction. And it's by this order, the responsibility. And the second, if we don't have this first one, then the second one is a mortgage lender, if you took a mortgage, and the seller's broker. And this language is for real estate transaction, for selling your house. And so the broker, it didn't define whether it include the consulting forester or not, but the language just says the seller's broker in general. And then the buyer's broker, and the last one is, if we don't have any of the 1 to 4, then the buyer are responsible for issuing 1099. I say that most consulting forester, when they do the transaction, if they don't do it themselves, at least they make sure one of these people are issuing this, because there are penalties and deadlines for issuing 1099, and it's not worthwhile that when we sell timber, that this is in the back of mind. It kind of worries people who is reporting. So now we're looking at the taxes for this year and beyond, for 2013 and beyond. There's a new tax called 3.8 investment tax. It applies to only high-income taxpayer. Beginning in 2013, investment income of a high-income taxpayer is subject to this new 3.8% tax. The high income is defined taxpayers with adjusted gross income of $200,000 for single, $250,000 for couples only. Now, if you filing joint return and we don't have adjusted gross income of $250,000, then we don't pay this tax, even on your timber sale. Now, we'll learn that most of the time our timber sale can be a investment income. If your income, AGI, your adjusted gross income, is over this threshold amount, $250,000 for couples, you are paying 3.8% on your timber sales. And this include the investment property and the passive business property. Now, if you're a material participant in your business, then you're not subject to this investment tax. That's another benefit of for business. Okay, now this is the last part of our first talk, is the sweeping changes by the fiscal cliff bill. It's enacted on January the 2nd, 2013. One of the main tax provisions affecting forest landowner is the long-term capital gain maximum tax rate. Now, for 2013 and beyond, the system will have two layers, two types. The maximum rate is 20%. If your taxable income, this is your taxable income, is over $450,000 for joint returns, or $400,000 for single taxpayers. So this is only changing the maximum capital tax rate. And if for the rest of the taxpayers who does not meet this threshold in the first one, the maximum rate is only 15%. And so this extended the previous 15%. As I said, so this $450,000 is for taxable income. That's after all of your deduction, and so this is certainly for different than the adjusted gross income. It's for very high paid income taxpayers. So for 2013, for this year, when we file our tax return next year, the ordinary income, the maximum tax rate has gone up from 35% to 39.6%. It's about like 5% increase. And this has been subject to a lot of debate about that 5% increase. But now it's become law that the highest, this 39.6% starts somewhere a little bit over 400,000 taxpayers, affecting those taxpayers. So in summary, the code does get more complex, of course. Your long-term capital gain tax rate, you could have a 0%, and you have a maximum of 15 or 23%. But you could also add that 3.8% investment income for high-income taxpayer. Their maximum rate could be for just the investment income 23.8%. Although that 3.8% is taxed on the excess amount over the set threshold. It's not on the entire your investment income. It's the amount over that 250,000 AGI. So certainly we can see the tax law gets more complicated here. I wanted to show you how this 0% capital gain tax rate, how does that work? For this year, when you file your tax return for 2012, the 0% rate applies to the long-term capital gains if the taxable income, including the capital gains, is up to $35,350 for individual, or $70,700 for joint return. And so what this means is that if you make $70,700 or below, adding your capital gain from timber sale, and that portion of the timber, the capital gain is taxed at 0%. You're not paying any tax on your timber sale if you meet this income threshold here. Now, if your income is over the $70,000, this joint return here, your maximum tax rate is either 15% or 20%, depending how high your income is. So you can see certainly the tax law does get a little bit more complicated as far as the calculation. And fortunately, this part we do normally use the tax software to calculate for us. But I suspect a lot of people does qualify for the 0% rate. And so this rate, Congress has extended permanently unless they change it again, but it's extended from 2012 to 2013 and beyond. So this 0 rate stays. Here's another quiz here. Reporting timber sale and claiming casualty loss may involve timber basis. Is this true or false? If it's true, yeah, it's one. You can put a check on it. Okay, I see that everybody is correct. Exactly. I put a little twist here. I thought if you didn't hear that claiming casualty loss also involves the basis, and that's the important part, is that once you purchase your property, you wanted to, even before you purchase the property, to start talk to a CPA or tax people that you set up your basis correctly. And like we said, the example that I showed you, it does involve a product. If you already have trees on it, you do want to work with a consulting forester to do the cruise and get accurate evaluation. And you can set it up retroactively if you haven't done so, and you can go back even 20 years. But you wanted to see whether hiring a forester versus that tax saving, which one is more beneficial, and may not, if the basis is low, you may not want to go back and do that. The evaluation does need a qualified professional to document that if our return is challenged. they wanted to verify the basis is not inflated to be able to claim on your tax return. And so as we can see that all this tax law gets complicated, and we have a brand new tax publication from the U.S. Forest Service. It's called Federal Income Tax on Timber, a quick guide for woodland owners. It's very easy, written for easy to understand, a quick guide. It's available on the web for a download, and you can just keyword search this title here. It's completely updated for doing your 2012 tax return. I'm going to answer some questions, and I'm going to give this to Dr. John Green to go over the timber sale and reforestation.
Okay, this is John Green. If you need me to introduce myself, I just retired from 20 years with the Forest Service on timber tax research, and I'm also a co-author on the Agricultural Handbook on timber tax for forest land owners and estate planning for forest owners. I'm going to talk about timber sales and income, and you see here the reference. This talk agrees with Ag Handbook 731. That's a new Ag Handbook that should be available next week online, and a few weeks after that in paper. Okay, so this is my first advertisement for that book. So when you sell timber, both the amount and the type of income that you receive are important. The amount is easy to calculate. It's the price you receive minus your timber basis, and also minus your cost of the sale. Linda talked about timber basis earlier. Cost of the sale we'll talk about in this talk. The type of income is important, whether it's ordinary income or a capital gain. And the reason for that is in most cases you would pay a lower tax rate on the long-term capital gains. So for 2012, as Linda talked about, there's a 10 to 20% tax rate preference for capital gains depending on what bracket you're in. For 2013, it may be 15 to 18% lower taxes on capital gains. Again, depending on what tax rate you're in. So the overall rates may be higher, but your tax savings from having a capital gain rather than ordinary income actually go up. Also, if you hold timber for use in a trade or business, any ordinary income that you receive is subject to self-employment tax at rates that go up to 15.3%. So that would be over 15% additional tax on top of the income tax. And there's other reasons related to Social Security if you're retired, and to losses. Okay, there's three factors that determine whether income you receive from timber is ordinary income or a long-term capital gain. The first is your primary purpose for holding the timber. The second is how long you've held it. And the third is the method that you use to sell or dispose of it. So we'll talk about those, each one of those one at a time. So the first one is your primary purpose. So timber that you hold as an investment, which Linda covered, or for personal use, is covered under Section 1221 of the Internal Revenue Code. It's a capital asset in your hands by definition. Excuse me. So gain from its sale or disposal will qualify as a capital gain, again by definition, regardless of how you sell or dispose of it. If you hold your timber for use in a trade or business, though, it's covered under a different section of the Internal Revenue Code, Section 1231. So in that case, it's not a capital asset in your hands, but gain from its sale or disposal can qualify for treatment as a capital gain. So all is not lost there. The holding period, Linda talked about this a little again also. It depends on how you acquired it. For timber you acquire by purchase, you need to hold it for more than 12 months. If you hold it by gift, or if you receive it by gift, you need to hold it again for more than 12 months, but this includes time that the donor held it. So the donor may have made the 12-month holding requirement for you before you actually received it. If you receive it by inheritance, there's no requirement, the assumption being that the decedent, the person that you inherited it from, met that holding requirement. So this holding period is measured from the date of acquisition to the date of disposal, and that's in quotes because there's a different definition of date of disposal depending on how you do dispose of the timber. So for method of sale or disposal, there's basically three ways. There's outright sale or exchange. There's a disposal with an economic interest retained. And also you can convert standing timber into products for sale and then sell the cut products. So these first two ways are selling standing timber. I'm going to focus on that. I'll just have a little bit to say at the end about converting standing timber into products and then selling the cut products. So the first one of those three methods is outright sale. This is the direct sale of standing timber for a fixed total amount agreed upon in advance, for example, through a timber deed or sale contract. So the common name for this is a lump sum sale. Once the sale is complete, the buyer has title to the timber and bears all risk of loss. So the seller no longer has risk of loss once the contract is signed and he has this check in his hand. Date of disposal in this case is the date ownership of the timber changes hands. This is the only definition for date of disposal for an outright sale, whether you're selling it as an investor or selling it as a participant in a trade or business. Timber is the parts of standing trees that are usable for wood products, and this includes evergreen or coniferous trees more than 6 years old when cut and sold for ornamental purposes. I should probably have a question on what that means. You can all say it out loud. It means Christmas trees, right? But not for evergreen trees sold live or the tops or other parts of standing trees that are used separately from the main stem. So it's just the tree itself. For many years, only owners who held their timber as an investment or for personal property qualified for capital gain treatment of income from the outright sale of timber. But since the end of 2004, owners who hold timber for use in a trade or business also can qualify for capital gain treatment of timber sold lump sum. This was accomplished by a change in the wording of Section 631B of the Internal Revenue Code that was put in place by the American Jobs Creation Act. All right. This is important to note that timber sold outright under Section 631B, so that stuff that the American Jobs Creation Act allowed, needs to be held, must be held more than 12 months to qualify for capital gain treatment. Income from timber held 12 months or less is ordinary income. All right, so only timber that you hold more than 12 months qualifies for capital gain treatment. If you hold it for less than 12 months, it's not a short-term capital gain, it's ordinary income. Disposing of timber under Section 631B gives the seller two important advantages. First, any gain that you realize is treated as a capital gain regardless of whether you sell the timber primarily for sale to customers. And secondly, timber disposed of under Section 631B is Section 1231 property, so that any gain or loss from the disposal of the timber is aggregated with other Section 1231 gains and losses, and a net gain is treated as a capital gain. So here's a true-false question. Is this the best possible outcome tax-wise? So either check yes or no. Okay, it's unanimous so far. That's right. Okay, it is the best possible tax outcome because capital gains are taxed at a lower rate. Okay, but a net loss is treated as negative ordinary income. So here's another question. Is this the best possible outcome tax-wise? Either yes, because it's deducted from dollars taxed at a higher rate, or no, because deducting from dollars taxed at a lower rate would give you a better outcome. Okay, this wasn't quite so easy, but it is, again, the best possible outcome. So no matter whether you have a gain or a loss, you have the best possible tax outcome. So let's work through an example. Let's say that last year a timber buyer knocked on your door and offered you $15,000 lump sum to buy 1,000 cords of pulpwood from your 150-acre forest tract. You agree. Your only cost of the sale is $350 to have your lawyer check over the contract. Just before the sale, the entire tract had 2,320 cords of pulpwood, and your cost basis, which Linda talked about earlier, in that timber was $32,408. So let's calculate, first of all, your timber depletion deduction, which helps you recover your basis, your investment in the timber, your adjusted timber basis, and your net taxable proceeds from the sale. All right, so your timber depletion deduction is your depletion unit, which is your total. Let me get a different. Which is your depletion unit, this part here. That's your basis in the timber, 32,408, divided by the number of cords on the entire tract. So this is your investment per cord on the entire tract, and then you multiply that times the number of cords that are actually sold. So your investment per cord is $13.97 times the 1,000 cords. You have a $13,970 depletion deduction. So you're not going to pay tax on that amount of your proceeds from the sale. And your adjusted basis is your original basis minus your depletion deduction, so it's $32,408 minus your $13,970 depletion deduction, so you have $18,438 left of basis in your timber. Then you would report this on Form T, Part 2. Okay, hopefully you all have a PDF file forwarded to you that you can read this better.
John, let me just explain that. Yes, there's handouts that are available for you to download at the Forestry Webinar portal. Both Linda and John's PowerPoint presentation as a PDF file, as well as all these forms that John is talking about now, are available for that download. So if you haven't done that already, you might want to go back and do that real quickly.
Okay.
It's right there. It's underneath the webinar topic for the day, under supplemental documentation. So, thanks, John.
Okay, so you can see from line 6 that you have 2,320 cords with your basis, your total original basis, and this shows your calculation of your investment per cord. Line 11 says that you're selling 1,000 cords of your 2,320 total, and your basis in that 1,000 cords is $13,710. There's no other adjustments, so you have this total reduction in volume, this total reduction in value, and the last line, line 16, is what you have left, 1,320 cords on the rest of the stand, and $18,438 of timber basis. All right, so besides illustrating or showing you how to do this calculation, this illustrates the effect of the first one or two sales from a timber tract, as that is going to use up most of your basis. All right, and then your net taxable proceeds from the sale is your $15,000 gross sale proceeds minus your depletion deduction and also minus your cost of the sale. So what you have in your pocket from the sale is $15,000, right? But what you're going to pay, well, minus the $350 that you pay the lawyer. But the only amount you're going to pay tax on is $680, and you report this on Form T, Part 3. Now, participants in a trader business, if you qualify as a participant in a trader business, you want to write a note that your income is reported on Form 4797, so an examiner would know where to look and be sure that you were reporting it. Okay, so here's a Form T, Part 3. This is the calculation of your investment per cord that was sold. Here's your total cost of the sale of your basis, and then your direct sale expenses is the lawyer's fee. You subtract that from your $15,000 income from the sale, and this shows just the what, $650 that you're actually going to pay tax on. Now, if you hold your forest as an investor, you report a capital gain from an outright sale of timber on Form 8949, which is a new form for the 2011 tax year. So you may not have seen that yet. And also on Form 1040 Schedule D. So let me see, that should be the next two slides. So here's the Form 8949. This was developed mostly to report sales of stocks or securities, but there is an option, C, you want to check the C box for a timber sale, that you're reporting a long-term transaction that wasn't reported to you on a Form 1099 B for investment. All right, so column A is what you're selling is 1,000 cords of timber. These dates in columns B and C are more than a year apart, so that qualifies you. The income is a long-term capital gain. The IBCD is the $15,000 total amount that you received. The $14,300, and I can't read it, but that's your basis plus your cost of the sale. So both things are added together in that column, and the $681 here in the last column carries down to the bottom. Actually, D, E, and I guess it's H are all carried down to the bottom. All right, so that's all you put on this form, 8797, and then you carry over to Schedule D. Okay, so you're in Form 1040 Schedule D. Part 2 is the part that concerns the long-term capital gains, and you write the same numbers basically over again. On line 10 here, this says you're reporting totals from forms that you checked box C on. All right, so your $15,000 income, your $14,320 of basis, plus expenses of the sale, and your $630 net gain. And on line 15, it carries down to line 15. Okay. Oh, wait. Do I need to go back? Let me check for sure. Okay, so we're still talking about investors. On these two forms, your income is going to be combined with other capital gains and losses, and a net amount and your total tax due transferred to Form 1040. Unless you only sell timber infrequently, you may be required to file Form T Parts 2 and 3, and you can expect to receive a Form 1099-S. All right, now, if you don't hold your land, your forest land as an investment, if you hold it as a business, you use different forms. You report a capital gain from an outright sale on Form 4797. It's going to be combined with other Section 1231 gains and losses, and your net gain transferred to Form 1040 Schedule D as a capital gain. Remember, that's the best possible outcome for a profit. But a net loss transferred to Form 1040 as a negative ordinary income, and again, that would be the best possible tax outcome. If you hold your timber as a business, you're required to file Form T Parts 2 and 3, and you also can expect to receive a Form 1099-S. All right, so here's a Form 4797. Here you want to work on Part 1, sales or exchanges from property held more than 1 year. It's basically the same information. What you're selling is 1,000 cords of pine stumpage. Your purchase date and your sale date are more than a year apart, so it qualifies as a long-term capital gain. Your $15,000 income that you receive is reported in the next column, the gross sale price, and then in the column F is your basis plus your cost of the sale. And the difference then, the $680 is your taxable gain. That carries down to line 7. Okay, so if line 7 is a gain, you go from here to Form 1040 Schedule D. So here's the Form 1040 Schedule D. And this form you want to be down in Part 2 because that's where the long-term capital gains and losses are for assets held more than 1 year. And basically you just write the number you just calculated twice on this form. On line 11 it's a gain from Form 4797 right there. And then that carries down to the bottom and appears again on line 15. And then you flip this form over and you work through a whole bunch of worksheets to figure out what your total tax is with that capital gain included. So that was an outright sale. The next thing I'm going to talk about is a disposal with an economic interest retained. And here a disposal, what it is disposal of timber under a contract that requires payment at a specified rate for each unit of timber that's actually cut and measured. So the common name for this is a pay-as-cut contract. Technically it's a disposal with economic interest retained, which means that the seller, that's you, typically retains title to the timber and bears risk of loss until it's actually cut and removed. Alright, so that places much more risk of loss on the seller, this type of contract. Date of disposal, here's our second definition of date of disposal, is the date when the volume of the cut timber is first definitely determined. So this probably isn't out in the woods. It's probably either when a truck gets measured on a scale on the highway, or at the mill gate when the truck gets weighed. So that could be actually some time after it's cut. Before the American Job Creation Act, a disposal with economic interest retained was the only method you could use to dispose of standing timber that was recognized under Section 651B, so that owners who held their timber for use in a trade or business had to use a disposal with economic interest retained to qualify for treatment as a capital gain. But as we saw a little while ago, that's no longer necessary. In a Section 631B disposal, the owner is any person or legal entity who has the right to cut the timber for sale or use on their own account. So it can be the holder of a sublease or cutting contract as long as they meet that more than 12-month holding requirement. So the original owner could meet the requirement, could qualify for 631B disposal, and then the person that they sell it to also could, if the contract lets them hold on to the timber, not cut the timber for more than 12 months, could also meet the requirement. I want to point out that selling timber for use in a trade or business on the shares with a harvester likely is a 631B disposal with economic interest retained for the landowner. All right, let's continue our example we did a little while ago and say that instead of accepting the timber buyer's offer, you decide to take bids for the 1,000 cores of pulpwood. A consulting forester solicits the bids, structures the sale as a disposal with economic interest retained, and administers it, charges you 10% of the gross proceeds. The best bid you receive is $22 per cord, or $22,000. Okay, so this is considerably more money than the buyer that knocked on your door offered you, if you remember it, in the last example. So this is just a little commercial for consulting foresters. So let's calculate your adjustments to your timber basis and your proceeds from the sale. So the adjustments to your timber basis are just the same as they were for the outright sale. Your timber depletion deduction is the same, $13,970, and your adjusted basis left in your timber account is the same, $18,438. You would report them on Form T Part 2, and it would look just exactly like it did in the last example. Your proceeds from the sale, though, you start off with a higher gross sale proceeds than you did in the last example, minus your depletion deduction, and also minus the consultant's fee. So you have net taxable proceeds of $5,000 $380. So you have more taxable income, but that's because you have more income. And you report this on Form T, Part 3. Participants in a business, again, want to include a note that their income is reported on Form 4797, so an examiner knows where to look for it. So investors report a capital gain from a disposal with economic interest retained on, again, on the same forms, Form 8949 and Form 1040 Schedule D. Again, you may be required to file Forms T Parts 2 and 3 unless you only sell timber infrequently. And the definition for this from the instructions to Form T is once or twice every 2 or 3 years qualifies as infrequent sales. So if you sell timber every 2 or 3 years, that qualifies as an infrequent sale. You can expect to receive a Form 1099. It might be prudent to file even if you're not required to, though. Participants in a business, again, report a capital gain from a disposal with economic interest retained on Form 4797. It's going to be combined with your other Section 1231 gains and losses with a net gain treated as a capital gain, but a net loss treated as ordinary income. So again, that you have to have the best possible tax outcome, whether you have a gain or a loss. You should file Form T Parts 2 and 3 in order to support your status as a participant or business in a trader business. So it's not difficult to qualify as a participant in a trader business. A lot of it is just holding yourself out as a participant in a trader business. So this is one way you can do that. Having a profit motive clearly designated in your written management plan is another way to do that. And again, you can expect to receive a Form 1099. So that's the 2 ways to sell standing timber. I'm just going to talk a little bit about converting standing timber into products and then selling the cut products because of time constraints. If you cut standing timber and convert it into logs or pulpwood or any other kinds of products for sale, lumber, paper, furniture, souvenirs, anything, all of the income that results is going to be ordinary income, which would be a terrible outcome unless you have the Section 631A election in effect. If you have that election in effect, though, then the income that results from holding the timber would be a capital gain. So it's just as if you sell the timber outright to yourself, and then only the value that's added by converting it into those cut products that you actually sell is going to be ordinary income. So since this is such a big deal, since it's so important, I want to show you where to make that election, and it's on Form T Part 2, way down at the bottom. There's a question. There's a line 18 here. It says, "Are you electing or have you made an election in a prior year to report gains or losses from the cutting of timber under Section 631A?" And you check the yes box. Okay, so that's where you make a 631A election. Okay, the other way, this is the long name for this kind of transaction. The short name is a Section 631A transaction. It's inherently a business operation. In effect, you are becoming an integrated forest products firm and selling the standing timber to yourself at a transfer price and then manufacturing products for sale. I just showed you where to make the election. It's less common. This way is less common than the other 2 methods of sales, and there's not really time to cover it today. But I do want to warn you that an arrangement where a consulting forester oversees a harvest and delivery of timber to a mill and then receives the payment from the mill and writes checks to the owner and to the logger for their shares, if that's the type of way these type of transactions are done in your section of the country, that's going to likely be a Section 631A transaction. Okay, so you need to be aware of those other requirements for using Section 631A. Okay, now I have a short presentation on reforestation tax incentives. It's pretty straightforward, but again, here's another advertisement for the new Ag Handbook, which should be available online. next week, and then in hard copy form within a couple weeks, or say a month after that. All right, so this is just to let people know that there are incentives that are provided in the Internal Revenue Code that eliminate the need to hold expenses associated with reforestation or afforestation if you're starting with bare ground in a capital account until you sell or dispose of timber. So these incentives allow you to recover your reforestation or afforestation expenses more quickly than having to sit and wait for the timber to grow and get merchantable size. These incentives were put in place by the American Jobs Creation Act of 2004 that we heard about just a little while ago. They allow you to deduct outright the first $10,000 per year of qualifying expenses and amortize any additional amount over 8 tax years. Okay, so I'll talk about those in more detail coming up, but who's eligible for these provisions is individual taxpayers, estates, partnerships, and corporations are eligible for both the deduction part and for the amortization part. Trusts are not eligible for the deduction part, but they can amortize the entire amount of the reforestation expense, okay? They're not restricted on how much they can deduct. They can deduct the entire amount through amortization deductions. What qualifies as expenses to establish timber on tracts that are at least 1 acre in size that's located in the U.S. and held to produce commercial timber products. So that can be either as an investment or as a participant in a trade or business. So this is not limited to plantations. It includes practices to encourage natural regeneration. Okay. Timber establishment, it also includes timber establishment expenses that are reimbursed under an approved public cost share program that you elect to include in your gross income instead of excluding it. Under Revenue Ruling 2003-59, you can exclude a calculated part of CRP, Conservation Reserve Program, cost share payments from your gross income. They used to have to be before 2003. You had to include them in your gross income. You cannot include, though, any part of a CRP sign-up or incentive payment. So that's one thing, one type of CRP payment you cannot include. Also CRP rental payments or payments for expected environmental benefits. These payments you still have to include in your income. There's also another section of the Internal Revenue Code that applies to farmers that says you can deduct tree planting expenses paid using a CRP cost share to a limit of 25% of your farming income. What does not qualify is costs of planting non-timber trees, and this includes Christmas trees, shelter belts, windbreaks, nut trees, fruit trees, and ornamentals. So there's a question is why don't Christmas trees qualify? Either A, they're considered a horticultural product, B, they typically get sold in less than 8 years, or C, the congressional tax writers made a mistake. So we need to let Eric set up 3 choices there, I think.
Sorry about that. I was copying and pasting the questions into a file. Snuck up on me.
Okay, but there are three options now, and option B is forging ahead, and that is the correct answer, is because the trees typically are sold in less than 8 years. What does not qualify is timber establishment expenses that are reimbursed under an approved cost share program that you elect to exclude from your income. So you get a benefit from the exclusion, so you can't take that double benefit. And also the cost of intermediate treatments, but of course you can deduct them year by year as you incur them. So the first part of this is expenses up to $10,000 per year. You can deduct outright expenses of establishing timber up to $10,000 per year. If you're married filing separately, that's half for each of you, $5,000 per year apiece. for each qualified timber property, or QTP. There's a lot of people interested in what a QTP is. The thing to keep in mind is that if you divide your holdings into 2 or more QTPs in order to take advantage of 2 or more $10,000 per year deductions, you cannot recombine these QTPs for calculating timber depletion or loss deductions. In essence, you've established 2 separate accounts then that you need to track all the way through the life of the timber until you harvest it. And you cannot recombine them. But most owners are only going to need 1 QTP for all of their forest holdings. It'll all fit within 1 QTP. Investors take the reforestation deduction on the adjustments to income line on Form 1040. That's line 36 for 2011 it was. I forgot to update this slide. What you do though is you write RFST for reforest on the dot. So you got to write, you can't do this on a fillable form, you have to write it with a pen. Occupants or participants in a trade or business take it on the other expenses line on the business form that they use. If it's a regular business, it's Form 1040 Schedule C. If it's for a farm business, it's Form 1040 Schedule F. Expenses over $10,000 a year that you can't deduct outright, you need to amortize, and this just means deduct over a set time period. Timber establishment expenses over $10,000. The amortization period in the loss is 84 months. If you divide, you would think that's 7 years. But there's a half-year convention that applies. You can only take a half a deduction in the first year, so it actually takes 8 calendar years to take a 7-year deduction. So you deduct 1/14 of the excess over $10,000 in year 1, a full 1/7 in years 2 through 7, and that last 1/14 in year 8. You need to specifically elect to amortize timber establishment expenses on an original return or on an amended return filed by the due date for an original return for the tax year that you incurred the expenses. So this is something you don't want to miss. If you're required to file Form T, you file Form T Part 4. Otherwise, you keep that in your records. You elect to amortize and take your amortization deductions on Form 4562. So that's a new form. Part 6, which is on the back. So I have illustrations of these. Here's Form T Part 4. This shows your calculation of how much, say you had $14,000 of reforestation expenses on 80 acres in a year. So your total is still 80 acres and $14,000, and your total reforestation expense is the same 80 acres and $14,000. The amount that you're going to deduct outright under Section 194B of the Internal Revenue Code is the $10,000 that you're allowed to, and the amount that you're left to amortize under Section 194A is the remaining $4,000. Okay, so that shows how much you're going to need to amortize, and where you take the amortization deduction, where you make the election and take the deduction is here on Form 4562 on the back, the very bottom little part. So what it is you're amortizing is qualifying reforestation expenses. The date, you want to put a date in the middle of the year since a half-year convention applies. It doesn't matter when during the year you do the reforestation. So you want to say June 31st, 31 days in June? Yes, or July 1st. All right, the amount that you're amortizing is the $4,000 from the last example. The code section that you're using is Section 194A. The nominal amortization period is 84 months, and your 1/14 of $400 is $281? That's too small to read. If you're starting 2 amortization schedules during this year, there's another line to add the second schedule. Also, line 43, it allows you to, if you have amortization schedules that you started in previous years, you can add them in here, and then you add them up and that's your total amortization deduction on line 44. Okay, if you're not required to file Form T, you still need to attach a statement to your return that shows your unique stand identification number, the total acres of timber established, the treatment you used, the total qualified expenditures eligible to be deducted for each qualified timber property or QTP. So basically, you might as well go ahead and file a Form T Part 4. Investors also take the amortization deduction on the adjustments to income line of Form 1040. Participants in a creative business also take it on the other expenses line of their Form D or F if they're a farmer. Any tax that you save by using either the deduction or the amortization provision is subject to recapture if you dispose of the timber within 8 years. There's an exception for disposals by gift, and there are also like-kind exchanges and voluntary conversions, tax-free transfers, and transfers of death are generally accepted. Okay.
Well, thank you. That was very thorough. I think it helps very much to have all those interactive questions in the forms. I apologize that the forms were a little bit small to read. It's hard to put a portrait form on a landscape slide. We do have some time for questions. Before we do that, though, while we still have everybody here, I'd like to, if everybody would, use your emoticons to give Dr. Wong and Green a big round of applause. I think they did a really bang-up job.
Great, thank you so much. And it's our job, and it's a pleasure to be here. Eric, do we do the questions now? What I was thinking is that I took a note of all the questions, and we don't need to go back to the chat window to find out exactly. I got the idea, so I can go over each questions, get the main points
Great.
to the.
Very good. I was doing the same thing too, so I'm glad that you did it as well. So go ahead.
Okay. Well, Eric, before I let you go, could you answer the question: is the session recorded? Will those people who come in late and who cannot participate today, when can they expect to tune into the archived session?
Right. As all of our webinars are recorded and will be available back on the forestrywebinars.net, and this takes a little bit of time for Collaborate to make that happen for us. Usually within a day or two, you'll see that recording available. And you'll access it just as you would with any previous webinar by going to forestrywebinars.net, clicking on the Previous Webinars tab, and following the instructions to start the webinar. You could also get credit through that process as well. Now, I will, as we're answering questions here, I'm going to provide a link to the satisfaction survey in the text box here. And you will need to copy that or click on it. It should be an active link. You'll need to click on that link to pop up to the survey that will be in the essentially the same portal page as you access your webinar. If you have any issue with that, be careful to make sure that you are using the same email address as you used when you logged on to this webinar. Otherwise, you might have an error. So I'm going to do that now.
Okay. So now, if you're not doing the survey and not listening to the questions, we are going to do the survey and the question section here. Now, one of the questions was asked is about TurboTax, whether this software can be relied upon to do the timber transactions. I have not checked this year's TurboTax, but up until this year, for the past all these years, this software does not even have a timber section. It does have a reforestation part, but the amortization you need to calculate by yourself by hand and put it in. And a lot of times the Form T, of course, is not in there. So if you're required to file that, it's not in there either. So I would not. I would say TurboTax is not having a lot of timber transactions in it at all. There's another question on the 500 hours for if your business property, do you have to participate 500 hours? That is just one of the, I think, 5 or 6 tests. You just need to meet one of them. So 500 hours is one. Now, if you think you can't meet that test, there's another test that says if you participate more than 100 hours and no one else participates more than you do, that also qualifies you as a material participant in your business. Another test is if your participation constitutes substantially all of the involvement in activity during the year, that also qualifies. That's a little bit subjective, but I would use those hours, try to document your hours. You participate, if you got a farm activity, then you also got a timber. Then as long as you participate in all of these 2 activities exceeding 500 hours for the year, then your timber qualify. You must qualify participate in timber for more than 100 hours. But combining with your farming activity, if you participate more than 500, then you also qualify for material participant. There is a yeah.
Can I also
Go
add
ahead,
that there's a 5 of the last 8 years test. So if you do the basically all of the work in 5 of the last 8 years, you can bounce back and forth between the essentially all test and the 5 of the last 8 years test.
Absolutely.
To qualify for as a material participant, it's not difficult. The IRS fallback option is that if you hire a consulting forester, then you're automatically an investor. But you can use these other tests to qualify from year to year.
Okay. Now, John, can you hear me? I forgot which button to push for the talk.
Yes, I can hear you.
Okay. There's a question on Christmas tree. In general, the Section 631A and B applies to Christmas tree sale, growing and housing a Christmas tree the same way as you produce timber. And so there's a specific question on whether if you sell Christmas tree retail or you have people cut your own tree, how does that, do they need to elect Section 631A? And most of the Christmas tree, especially the retail, when you sell the tree, the cut trees, then a Section 631A applies to most of the producers. The tax law says if you cut the tree, if you sell the tree uncut, you sell the tree on the stump, then it's a Section 631B transaction. It's capital gain provided you meet all these other holding period. Then you don't need to make a election. Otherwise, in most part, you do want to make that Section 631A transaction the election. Okay, and there's
if it's a choose and cut operation, it's not a 631A. You want to file under 631B. The new Ag Handbook that will be available next week has the Christmas tree chapter. Has a Christmas tree chapter that's been updated and revised to be very clear about that.
Yeah. So John, just to repeat what you said, if you ask the customer to cut their own, so that means that they sell the Christmas tree on the stump, and that's a Section 631B transaction. They don't need to make a transaction for that.
Right, because the customer is not working for you.
Okay. already, and I just feel that for a Christmas tree producer, all these different rules, and I hope it's a little easier, but what the tax law basically says that the tree, when it's not cut, it's a capital asset. The appreciation on the tree, that's the tax law give you the capital gain treatment. Once you cut it, it's a product. It's not going to be like a real estate asset anymore. So that part of the gain that you derive is the ordinary income. The next question is on cost share. Is the cost share, if the cost share payment is used for forest management plan, is that income or can that be excluded from income? I say the fees paid for forest management plan, including the cost share, they are deductible expenses. I think to be cautious, I would include them in income because they are normally a deductible expenses and they're not capital expenditure.
Okay, I wanted to add to this also, is that if you read the law, that's what the law says. But if you read the IRS revenue rulings that either approve or don't approve of cost share payments for being excluded from income, for most of the approved cost share programs and all of the federal programs, all payments to reimburse actual practices are approved for exclusion from income. So there's some programs that don't even do timber practices, just for wildlife habitat improvement or water quality, and those payments are approved for exclusion from income. So that's what it says in the IRS revenue ruling. So that is the IRS position on these what they call small watershed programs.
Yeah. So what John is saying, those that does this soil conservation type of program, those are qualifying, even though they're not producing timber per se, but they are approved program.
Right.
Thank you for adding that. And the next question is, they have, when we go over the ownership of the land, we only go over whether you hold it for investment or business, and we are focusing on producing for income producing purpose. You hold your timber for producing timber, and the question is on other legal form, tax legal form. For example, if someone, the conservation trust, people donated the trust to the conservation trust organizations, and the trust now manage these kind of the forest land, and how that is different than the normal small woodland ownership that we're focusing on here. The main purpose is to produce timber from growing timber for profit. Now, if you're a conservation trust, I think your purpose probably are not for profit, and it's different than the rules here. You can have that kind of ownership, but most of the nonprofits, they are not concerned about tax. They're not paying tax, but if they have unrelated business income, they do. They pay tax on that. And I think those rules are different than here. Yeah, the ownership can have many legal ownership, corporations, S corporations, partnerships. Family can also set up those, even the corporations. For the trust, there are different types of trust, and for a individual, if they set up a trust to own the land, if it's a revocable life trust, it's treated the same as if you own it yourself. You file a fiduciary return, but for the most part, the capital gains, reforestation for the trust is a little bit different. You can't amortize, but can't take the whole deduction. But for the most part, for the individual level, tax is different than the organization who are a conservation easement trust. So there is another question on the Section 501c, nonprofit organizations. This landowner, this person says, am I concerned about timber tax? I think there's probably either a forester or a tax people answered that question, is that 501c non-for-profit, normally they are not concerned about tax, but if they have unrelated business income, if timber is not related to their business, then they might be concerned about tax. So that's similar to the answer that person already got the answer on that one. There's another question on capital gain. Is capital gain subject to self-employment tax? Normally, capital gain does not subject to self-employment tax. And that was one of the main benefit too of having capital gain other than a tax rate difference. But for 2013 and beyond, that 3.8% investment tax, that is actually a Medicare tax, which is for self-employment people. That is also called self-employment tax. Self-employment tax is equivalent for people who are paying by W-2. The paycheck would be called Medicare, and Social Security tax for self-employment tax people, then that would be equivalent called self-employment tax. And for high-income taxpayer who are making $250,000 adjusted gross income, who have timber investment income over that threshold, they are subject to that 3.8%. I call it investment tax. Actually, that law was passed as part of the 2010 healthcare reform bill. That is part of that bill that says for higher income people, investment income is paying that 3.8% to pay for the Medicare cost. So for high income people, capital gain can be subject to self-employment tax from now on. And John, there's a question on non-timber product. I think they're asking whether the capital gain tax law rules apply to the non-timber product that you just go over. I think probably not, but if you wanted to address this question.
Hang on, let me answer.
For non-timber products, most likely they're not capital gain
treatment.
The capital gain
would be there's a revenue ruling that says removal of stumps all in one operation from a recently purchased tract qualified for capital gain as a capital gain. Also, if the product itself takes several years and a lot of effort to produce, and here we're talking about cultivated medicinal plants like ginkgo or black cohosh, that can qualify for capital gain treatment. There is a new chapter in the Ag Handbook that talks about non-timber forest products, and that's about the only ones that do qualify for capital gain treatment. There's a whole list of other ones, products from slash, wild collected samples or medicinal plants. All that is ordinary income. Lease income is all ordinary income. But there's a couple of exceptions where you can qualify for capital gain treatment.
Thank you very, very much. I think that's probably all the questions, and people want to find out where they can find the download of the form and the presentation. So I think, Eric, you already sent out the email, the link to that, and so you might want to tell the audience that if you want to get the PowerPoint, how can they get it?
We provide instructions on that enough times already, but I do want to address the questions here to John. They're asking to make sure they know what the document title is that you are talking about that's going to be out soon, and if you have a URL that we can provide them to where to get that.
I don't have the URL yet. I'm sure if you look on the TimberTech's website, it will be there as soon as it's available.
So it will be at the TimberTech's website, and the title is called what?
it would be Forest Landowner's Guide to the Federal Income Tax. It's the same title as before. It has has a prettier cover and a new number now.
Very good.
Oh, I got one more question. I'm sorry for that, to cover that. And John, this is for you for the reforestation. If your investor, there was a specific amortizable amount, so they were asking, can I put in line 36? Basically, they're saying on the adjustment section of that 1040. Right. Could you answer that? Where do they put the amortizable amount plus that 10,000 for investors again?
Okay, you put it on the same line as you would for the deduction. You have to write in, I guess, a RFST again, and and the amount that you're adding to the adjustment on the dotted line, and this included in the total. So you just have to take a pen and ink and write it in on the dotted line for the total.
Well, guys, that's really good. I think.
Okay.
Unless you had anything more there, Lynn, I think we need to wrap up the webinar for now. Okay,
there is one more question.
Okay, go ahead.
I see one more question on a cost share that's used for thinning or infestation. I think that does not. You're gonna need to report that as income. For thinning forest, even though you have spent it on, but it needs to be reported as income, because the thinning is a deductible expenses.
Oh, thinning, yes. But then you can turn around and deduct it as an expense. That's a deductible expense.
Yeah, you include that payment as income, but then you have an expense to deduct that. So, okay, I think.
Very good. Thanks so much again. The presentations were very helpful, I think. Made it as clear as possible. Of course, my head still swims every time we talk about taxes. Thanks so much, guys. And I'm sorry that I was a little off cue there on the polling questions. But what I did was I detached my tab, and my buttons would not work. So I'm having to figure it out until halfway through. And that concludes our webinar.
Thank you so much.
All right, thank you, Eric, and thank you all the attendees.
Bye-bye.